Hey folks, Tim Kulhanek, Stonebridge Wealth Systems co-founder and financial advisor, coming to you just with a quick market update. It's the evening right now. I'm recording this the evening of Monday, March 10th, 2025. Market closed down substantially today. The Dow was off, like 2%. The Nasdaq tech-heavy stocks in there, tech-heavy index in there, was down about 4%, so substantial decline for a one-day return, and then the S&P was down between 2.5% and 3%. I think 2.7 is where it ended. So, got some folks that are probably wondering, what's going on, and is it time to, panic, or do I need to, pack my bags and start moving to the sideline, or moving in with Tim? And the answer is, my kids' stuff have taken over our basement, and so the room I had for you, unfortunately, is no longer available. But Jeff and Jeremy both have volunteered for that duty. But no, I think it's a good time after we just came off of 2 years where basically we had no volatility at all. I mean, you only had two small pullbacks in 2024 the entire year. I sometimes call those last couple of years unicorn years because while my 4-year-old tells me that she has a magical unicorn, they're good friends. It's a nice unicorn. I try to tell her it's a biting mule, but she says, "No, no, Dad, it's a nice unicorn." She takes it for walks. When they go to the park, that's where it lives. It has a leash, but when it's time to go home and she tries to bring it home, it always breaks off its leash because it just lives at the park in the woods because it's a magical unicorn that I've never been able to see. Which the last couple of years in the stock market are ones we typically don't see, where you've got really low volatility and really good returns. It was a great time to be an investor. It's just not the norm. Okay. So let's talk about that. Let's talk about what's happening today, and let's talk about what the game plan is from your team here at Stonebridge. So what are we doing and what's happening? So first, you need to understand that market corrections are normal. This is actually more normal than it is abnormal, what we're seeing right now. If you look at the chart I put together here from Ned Davis Research and Clark Capital Management Group, I define it in 5 different categories. Okay, dips, pullbacks, corrections, severe corrections, and bear markets. So, you know, throughout the course of a year, you're going to have multiple dips. Okay, multiple times the market pulls back from a recent high, at least 3%. Okay, on average, there's about 7 per year, every single year. What about pullbacks? What about a 5% decline? I saw somebody commenting online the other day that, oh my gosh, this is not normal, folks. We got a 5% decline in 1 month. It happened, I think, 5 or 6 out of the 12 months in 2022. It happens quite a bit, actually. There were times back in the 90s where the market would have multiple corrections. Those 10%, the next category, declines intra-year, right? And yet it would still turn out, a nice double-digit return some of those years. Keep in mind the average intra-year decline going back to, I want to say, like 1995 is 14%. So usually you have about a 14% swing every single year in the market on average. Okay. And about every year, you should expect to see a correction every single year. Now, what about those more dramatic types of declines? This could turn into, I really don't know, we'll call bear markets, where it's a 20% decline from a recent high. And we're not measuring from January 1st of the year. We're measuring from when the last all-time high was hit, which I can't remember when it was for sure. But believe it or not, we already had at least one all-time high here in 2025. It probably seems like it's been 3 years because we have this recency bias where, whenever things are going well, we forget about how bad they were not all that long ago. And when things are going bad, we forget about how good they were going not all that long ago. On average, about every 4 years, just over round numbers, you're going to have a bear market. And so the average length of a bull market, a length of time for a bull market, which is a positively moving, increasing market, is about 4.1 years. That's skewed a little bit because we had the longest bull market in history from 2009 through 2020. But even if you remove that one, it's still only like 3.7 is what it goes down to. So chart's pretty darn accurate, right? About every 4 years, you're going to have a 20% decline in the market. The question is, how do you react? So it's not so much what happens to you, but how you react to the things that happen. Because if retirement lasts 30 years, if you're fortunate enough to have a retirement that could last as long as 30 years, you're going to have at least 6, if not 7 or 8 bear markets that you have to be able to navigate. And really, the answer to whether your retirement is going to be successful from a financial perspective or not is how you react to those types of things. Because investing in the stock market, I like to say that this volatility we're experiencing right now, it's kind of the price of admission. So where are we at? Is the market going to turn around tomorrow, Tim? Is that what you're saying? That everything's, sunshine and rainbows? Or as one person once said, four-wheelers and flamethrowers, I think it was. Um, no, I don't know. I mean, if I did, I would be on a beach, right? But the reality is, right now, investors are really, really, really unhappy with how the market's going. And I shouldn't say unhappy; they're really scared. Okay, so this is a measurement of investor sentiment. Are investors optimistic or pessimistic? This is different from consumer sentiment. All right, that has less to do with the market. That's a study by the University of Michigan, and that has more like, do they think the economy? Are they optimistic about their job prospects and that sort of thing? This is specifically investor sentiment. And this is the percentage of investors who are indicating that they have a pessimistic, what we call bearish outlook. You can see that up here in the top left of the chart. And it spiked here just the other day. It was above 60%, which is crazy. I mean, it's nuts because it didn't get that high really until the bottom of the market in 2022. But the reason I even show you this chart is because historically this has been a really good what we call contrarian indicator. Essentially, whenever this thing spikes, it's usually about the time that the market flips and it starts going the opposite direction. It starts going up. I'm not telling you it's going to go up tomorrow, guys. I don't know. But what I do know is history doesn't always, doesn't necessarily repeat itself, but it does often rhyme. So these are some of the tools and some of the metrics that we can use to try to map out what's happening today, make sense of it, and move forward. Now, what sometimes people will do is they'll say, Tim, well, but I remember something that's also a parallel today, and it was back in the early 2000s, and they called it the tech bubble. And the Nasdaq went on to lose 78% of its value, and everything, fell apart, and I lost all my money, and blah blah blah. Well, like the difference between now and 2000 is the reason there was a tech bubble is because you had companies that had no business really being invested in whatsoever because they were essentially zombie companies. They had no earnings, and yet their stock prices were sky high. For example, if you bought, let's say you had 100,000 shares of pets.com on February 1st of the year 2000, you're a millionaire. Congratulations. Back 2000, $1 million went a lot further than it goes in 2025. But what did pets.com have? You guys remember? They had a little sock puppet, and rode around in a car and it was like I think they had a Super Bowl ad, and it had like the bullseye type circle around its eye. It was really goofy. Well, by December of that year, you were no longer a millionaire. In fact, you were broke. You had no money because pets.com went out of business because they didn't make any money. That's not what's happening, at least with a lot of these big companies that we're talking about here today. So this is the S&P 500 operating earnings per share, both actual and estimated, going back to 2020. And what you see here is, like, at the end of the day, when you're investing in the stock market, you're investing in companies because you think they're going to make money, right? Nobody invests in companies because they want them to lose money. That's not a thing, right? For the most part, like, again, there's some little technical engineers that are going to listen to this and be like, well, but what about, and just come on. People want to make money and they want to see the companies are investing and making money. So from 2020 to 2021, we saw huge earnings growth in the S&P 500. Okay, and this is, if you look at how they do this, they will call bottom up, where they're going to look at the individual companies first, and then they're going to kind of combine it all together based off the weightings in the S&P. And from 21 to 22, you saw actually a decrease in earnings. And what happened in the stock market? It lost money. So what drives returns? Earnings. Okay, if the earnings are going up, that's good, and stock prices tend to appreciate. If earnings are going down, they tend to go the other way. We've seen great earnings, right, in the S&P. And if you look at the consensus estimates from S&P Global for 25 and 26, I had 27 on there, and I deleted it because it's like, who knows what's going to happen tomorrow, let alone 3 years from now, or 2 years from now, but also basically 3 years from now, because you look at the end of that year. Like, it looks like that's 14% year over year growth in earnings if those estimates are relative. And even if they come back by half, you're still talking about 7% earnings growth. Again, it could change rapidly. It could change drastically. Right now, I would say the main thing driving this market volatility and this kind of panic on Wall Street really is because the retail investors, let's go back one chart, like this shows most investors are terrible at investing because they invest with their emotions, right? They wear their emotions on their sleeves, and then they let their fear drive their decision making, right? They become very irrational. That's why Warren Buffett said famously years ago, be greedy when others are fearful and fearful when others are greedy. Um, so that's one thing to consider. The other thing is that, like, if you were to hop on a flight, let's just put it this way. If you were to hop on a flight, first thing in the morning, going from New York to LA, what's one thing you can almost take it to the bank, guarantee that you're going to experience during that flight? First of all, hopefully you're not in the middle seat. Nobody wants to be in the middle seat, okay? Especially in the back of the plane. Second of all, hope you chose to purchase a ticket on an airline other than Frontier or Spirit, because if you're flying across the country on Frontier or Spirit, that's cruel and unusual punishment, okay? Because those airlines, basically what they do see is they take folding chairs, they tape them to the interior of the plane, and then they just say good luck. What you're actually going to experience regardless, though, is you're going to experience what we call turbulence, right? There's going to be some bumps along the way. If you're investing in the stock market, there's going to be bumps along the way. But at the end of the day, if the company I'm investing in is making money and the price goes down, if it was a retail product, if it was, think about it this way: if we were buying a snowblower and instead of paying 1,000, we only have to pay 800 because it's the end of the season and Home Depot or whoever wants to move their inventory, we'd call it a sale. It still has all the same value as a brand new snowblower that somebody else a couple months ago paid $1,000 for, right? They didn't remove the auger and say parts sold separately. But we think that's a great deal. But when it comes to stocks, if companies are still making money, yet their prices go down, instead of calling a sale, everyone panics and loses their mind and thinks that the sky's falling. Now, what does this all mean, and what's the key takeaways here? First is, one, this isn't specific advice. I'm not telling you to go buy stocks tomorrow. Okay. I don't want there to be any confusion about that. What I am telling you is, if you focused on creating a plan, and like here at Stonebridge, for example, if you're a client, it's going to make sense. We use what's called the Retirement Compass. It's a proprietary system that we developed over the last 15, 20 years. That's basically a systematic approach to investing, looking at what we call the 5 key areas of planning. And if you have a plan in place, and part of that plan includes your investments, and within that investment plan, you've properly allocated between the 3 key buckets, if you will, risk buckets. So I wrote a TV show on this called Seeking Goldilocks Risk Buckets. You've got safety, income / growth without risk, and growth with risk. If you have proper diversification, if you have proper balance, when these things happen, when you have market dips, pullbacks, corrections, severe corrections, or bear markets, guess what happens at night? You just sleep just fine, because you know that you have a plan that's been mathematically tested. It's designed to work in up markets, down markets, sideways markets, you name it. So I hope this was helpful. I hope this is a little bit of a, reinforce some of the principles that we've talked about for as long as we've worked together. If you're watching this and you're not a client, and maybe you're not getting this, type of commentary or insights from, your current firm that you're working with, if you have a current firm, shoot, one of our advisors, even myself included, we'd be delighted. We'd love to have a conversation with you, 15-minute phone call, just to kind of chat about, hey, how does this apply to you? And what are some of those safety nets that we use that are helping our clients sleep well at night, knowing that they've got a strategy in place, a safety net in place that's going to help buoy their portfolio in times of market distress? Gosh, we'd love an opportunity to talk to you. So clients, thank you for your, trust, confidence you placed in us. If you know someone who would benefit from this, this outline and this kind of overview, by all means, please forward this email on, so we can get it into more hands and more folks can, hopefully have a little bit more peace of mind in navigating these kind of scary, when this happened, it's scary for sure, but also like really critical times in your investing life cycle, if you will, because in order to get the good long-term returns, you got to have the short-term pain to get the long-term gain. Look forward to chatting with you guys again soon. Thanks.